Hello, and welcome to Finance, Business, and Investing. In the video for today, we'll watch a short talk about the basics of money and investing. So let's get started so you can learn more about money and some of the basic terms related to running a business and investing in one. I'll use a lemonade stand as an example. We're going to start selling lemonade. So, I'm using a lemonade stand as an example because it's a very simple way to understand the basics of business, how our business works, and how it makes money. How to get money to start a business. What to do when you're ready to turn your investment into cash or take some money off the table. You'll be able to understand each of these ideas by looking at a small business just starting out. We're going to start a company and a lemonade stand, but I don't have any money right now. So, I'll have to find investors to give me money to start the business. So, how do I go about doing that? So, I'm going to start a business. You fill out a small form with the state and think of a name for your business. We'll call it Bill's Lemonade Stand, and outside investors will give us money. We need some money to get things going. So, we'll get 1,000 shares of stock to start our business. We're going to sell 500 more shares to an investor for $1 each. The investor will give $500. We will post the name and the idea, we'll have 1,000 shares. He will get 500 shares. For his $500, he will own a third of the business. So how much is our business worth at the start? It's worth $1,500, plus $500 in the bank and an extra $1,000. Because I thought of starting the business. I need about $500 more than that. So, what will I do? I'm going to borrow some money from a friend. He's going to give me $250, and we're going to pay him 10% interest on the loan every year. Now, why don't we just sell more stock to get the money we need? Well, we keep more of the stock for ourselves when we borrow money. So, if the business does well, we'll get a bigger share of the money it makes. So, let's look at what the business looks like on paper. We're going to look at something called a balance sheet. A balance sheet tells you where your company stands, what your assets are, what your liabilities are, and what your net worth or shareholders' equity is. You take your assets, which in this case are the $500 we've raised. Only about a third of the business belongs to the person who put up the money. The other 2/3 belongs to us because we started the business. Well, that's a $1,000 boost to the business's reputation. We got a $250 loan. We're going to owe $250. That's a bad thing. So, selling stock gave us $500 in cash, and getting more debt gave us $250. And we owe $250 loan. And we have a company with shareholders' equity of $1,500. How do we get our business started? We need to spend about $300 on a lemonade stand. This is known as a fixed asset. Unlike lemon, sugar, or water, this is a building that you buy and put together. It wears out over time, but it's a fixed asset, and then you need to buy more stuff to replace it. To make lemonade, what do you need? We need sugar, you need water, lemons, cups, and small containers. And maybe some napkins. You also need enough supplies to make, say, 50 gallons of lemonade for your business's first day. Now that we know that 50 gallons makes about 800 cups of lemonade, we're ready to start. Let's look at the balance sheet again. So, we've now spent $500. Only $250 is left in our bank account. But we now have $300 in fixed assets. That's where we sell lemonade. Our stock is worth $200. Those are the things and supplies. We have to make lemonade out of lemons. So, all of our assets add up to $1,750. The person who lent us the money is still owed $250, and shareholder equity hasn't changed. No money has come in. All we've done is take the money we had and turn it into other things we'll need for our lemonade stand business to work. Let's make some guesses about what will happen to the business over time. We'll assume that we'll sell 800 cups of lemonade every year. We'll assume that we can sell each cup of lemonade for $1, and that it will cost us about $530 per year to run our lemonade stand. Let's look at the income statement next. So, the income statement talks about how profitable the business is, how much money it made, how much it spent, and how much money was left over for the owner. We have one lemonade stand where we sell 800 cups of lemonade for $1 each. So we make about $800 in sales each year and spend $200 on inventory. There is a line item called cost of goods sold, or COGS. We have depreciation because our lemonade stand wears out after 5 years and looks a little worse for wear. So the value goes down over 5 years. We have to pay people to pour the lemonade and take money from customers, which is our labor cost. We're making money when we have a little bit. That's $10 before interest and taxes. It's kind of like our business's profit before taxes. Taking that $10 profit before taxes and comparing it to how much money we make shows that we don't make very much. About 1.3% is the difference. That's not a huge amount of money. Now, we have to pay interest on the money we owe. We lose $15, and we don't have to pay any taxes. But we still lose money at the end of the day. Should we keep putting money into the company? In the first year, we've lost money. Should you give up? Well, let's give it some thought. Let's make some guesses about what the company will be like in the next few years. Let's say we use all the money the business makes to buy more lemonade stands, so the business can grow. Let's say we don't take any money out of the business. We won't pay a dividend, so we're going to keep all of the money in the business and put it back into it as we build our brand. Every year, we can charge a little bit more. So, each cup of lemonade will cost about $0.05 more each year. Then, we'll assume that each stand can sell 5% more cups per year. So we have growth assumptions built in. Now, let's look at the business. So, check out this chart. You'll see that in year 1, we only had one lemonade stand. Each year, we added one more, and by year 5, we had 7 stands because we had a big plan to grow. Every year, our price per cup goes up by a nickel, and from $800, our income starts to grow quickly. And the growth is because the price of a cup of lemonade has gone up. And opening more stands also helps. So by the end of year 5, we've made almost $8,000. Most of our costs stay the same, like lemonade and sugar. It's about $1,702. As more and more stands wear out over time, we have depreciation. We have to pay for labor, but by the 5th year, the business is doing pretty well. We went from having a margin of 1.3% to having a margin of over 28%. The business is now at full scale. We're starting to pay for some of what we need. We're getting bigger, we're still paying $25 a year in interest on our loan, and by the end of the 5th year, before taxes and interest, we'll have made $2,300. So, we put $500 into the business and borrowed $250. After 5 years, we've made a $2,300 profit. It sounds like a good idea. Now we have to pay about 35% of our income to the government in taxes. We generate net income. Or, another word for profits of $1,500 in the 5th year and about $1 per share. So, if you give this some thought, our friend spent $500 to buy 500 shares of stock, which cost him $1. And if our business goes the way we expect it to, he'll make $1 per share after 5 years. It sounds like a pretty good deal. Let's look at the statement of cash flows. So, as the business does better and better, we get more and more cash. We go from having $500 in cash in the company to having more than $2,000 in cash over the course of the period. The shareholders' equity was $1,490 when the balance sheet was first made, but as the business makes more money, the profits add to the cash and increase the company's assets. Our debts haven't changed, and the business keeps getting more and more valuable. By the end of the 5th year, we have $4,000 in shareholder equity, which is almost 3 times what we had at the beginning. Now, is this a good or bad way to make money? How do we decide whether something is good or bad? One thing to think about is how much money we get out of the business compared to how much we put into it. This is a business we thought was worth $1,500. When we first started the business, someone put up $500 for a third of it. We say it's worth $1,500, but by the end of the 5th year, it's made $50 more than that. So we got back more than 100% of the money we put into the business. In fact, that's a pretty big number. We put $2,100 into building lemonade stands and made back $2,336 in the 5th year on the money we put in. That's a return on capital of more than 100%. That's a very good return, since earnings have grown between 100% and 55% per year. This is a real growth company, and by year 5, our profit had gone from 1.3% to 28.6%. That sounds appealing, and it is. So, let's look at the person who put up the loan. That person put up $250, and the business has been successful. We were able to pay them the 10% interest they were due, which is $25 a year. And they're happy because they put up $250, they're getting a 10% return on their loan, and the business is worth much more than $250. We have more cash than that. Because of this, they are safe, but they have only made 10% of their money back. Now, let's compare that to the equity investor, the person who bought stock in the company made $1 per share in the 5th year, compared to investing $1 per share. So he's getting a return of over 100%, or about 100%, on his money, while the lender is only getting a return of 10%. So who made out better? Clearly, the equity investor, but why does the equity investor get to earn so much more than the lender? The reason is that they took more chances. If the business goes bankrupt, the lender is entitled to the first $250 of the company's value. So, if you sell the lemonade stands for $250, the lender gets all of their money back because they got their 10% return while the business was running and the $250, but the equity investor, the person who bought the stock, loses everything because they go after the lender. So, what's the difference between a loan and a share of ownership? Debt is usually a safer investment because it gives you a higher claim on a company's assets and comes in many different forms. You've probably heard of mortgage debt. That's a secured loan backed by a house, but a building can also be mortgaged for a business. There is senior debt, junior debt, mezzanine debt, and debt that can be turned into cash. Bottom line, it's all debt. In a company, it's important in different ways. And you know that the rate you charge is the opposite of how safe you are. So, the lower the risk and the better the security, the lower the interest rate you can get. The higher the risk and the lower the security, the higher the interest rate you can get. But you don't have to. You can avoid the messiness. All you have to remember is that your debts come first. It's safer to go it alone, but you won't be able to make as much money. Now, they also know that there is something called preferred equity or preferred stock in the equity. There's common equity or common stock. Again, stock and equity are pretty much the same thing, and their choices aren't really worth talking about today. The important thing is that equity gets everything left over after all debts are paid. So we call it a residual claim. The good thing about the residual claim is that the value of the business goes up. You no longer own your lenders, but all that value goes to the stockholders. So, the question is why the lender was willing to take only a 10% return when the equity earned a much higher rate of return. When the business first started, there was no way to know if it would be a success or not. And the lender made a bet that they could sell the lemonade stand, which cost $300 to make, if the business failed. Even if they sold for much less than the dollar they had planned, they would have some lemons and some lemonade. The person who lent the money was pretty sure that they would get it back. The stockholder, on the other hand, is really taking a risk. They were betting that the business would make money, and if it didn't, they would lose everything they had put into it. So they had the right to get a higher return or the chance of getting a higher return if the business did well. Let's talk about risk. People often say that the biggest risk in the stock market is that stock prices will change every day. We don't think you should be worried about that risk. The risk you should be thinking about is how likely it is that you will lose your money if you invest in a business. But if you want to invest your own money, you're going to lose it forever. Don't worry too much about how much the price goes up and down in the short term when deciding between two investments. In the end, what matters is whether or not you get your money back or make a profit from your investment. How do you feel about danger? One way to think about risk is to compare it to other options so you can decide whether to buy government bonds or not. Government bonds are thought to be the safest way to invest today. And the US Treasury sells bonds with terms of 10, 3, and 5 years. There is a set interest rate, and right now, if you buy a 10-year Treasury, you get back about 3%. So, if you give your government $1,000, it will give you $30 in interest each year. After 10 years, it will give you your $1,000 back. So, that is extremely safe. And that gives a sort of floor. Now, you're going to have to make a loan. You can give the government money and get 3% back. You can give a lemonade stand money. You want to make a lot more money. In this case, the rate of interest charged by the lender is 10%. Why 10%? Because starting a lemonade stand is a riskier business. They want to make a nice fat spread over what they can make lending to the government. Stock investors think about things in a similar way. So, the higher the valuation, the riskier the business, and the higher the rate of return the equity investor will expect, and the lower the risk, the lower the rate of return the equity investor will expect. And equity investors don't get interest. Just like a lender does. What equity investors get is the chance to get dividends from a company over its lifetime. Let's talk about how to get money. You got this lemonade stand going. In the first place, this was done to make money. Things are going well in business. I started the business, came up with the name and the idea, and hired everyone, but I haven't made any money. Right? So the value of the business has gone up. Where is my cash? I need money to buy a car, for instance, one that costs $4,000. What should I do? How can I help? Well, we've spent all the money that the business makes. We put the money back into the business. We now have all that money, which is good news. We've been able to use it to buy more lemonade stands, which are making the business more and more valuable. Instead of buying more lemonade stands, I could have just paid myself dividends. Now, the good news is that I make money while I'm doing that. The bad news is that this would slow the business's growth. And if your business is as successful as this lemonade stand business and you can make hundreds of dollars from each new stand, it makes sense to keep putting money into it. How do I keep my business going and growing? How do I take advantage of opportunities and still make some money? I can sell my business of selling lemonade. This one I began in New York. Maybe someone in New Jersey wants to buy me and my lemonade stand business together. The problem with that is that if I sell it, I won't be able to take advantage of the opportunity in the future. I think this business will do very well over time because I believe in it. So that's one possible choice. Other options besides selling the whole business are to sell a piece of it, which I can do privately. I can find a private investor who wants to buy a share of the company. And if the business is successful enough, I can sell them a piece of it, and we can all do well. I can also take the business public as a third option. An IPO. The term IPO stands for Initial Public Offering, which means that the company is going public for the first time. When you go public, you sell shares to the general public instead of to a single investor who is interested in your business. And it's a gift because you're giving people the chance to take part. IPOs don't make people rich, which is interesting. All it really does is sell a piece of a business they already own to the public and get it listed on an exchange. When you decide to go public with your business, you'll have to tell a lot of people about it in order to get them to invest in the Securities and Exchange Commission. They will think carefully about this point of view. You will make sure to talk about all the risks that come with investing in the company. You will also have the chance to talk about the business. That's an exciting time for you, because selling shares to the public is usually the best way to get the highest price for your business. However, you don't have to sell all of your business to the public. In fact, you usually only sell a small part of what you have. You get to keep the rest and keep control of the company, but you get to raise money through the offering. You can use that money to buy the car we were talking about earlier, before you decide to go public or sell it at all. It might be smart to find out how much the business is worth. So let's talk about how to value a business or how to value it. One way to figure out how much your business is worth is to compare it to others like it. Now, the stock market is an interesting place to check out. The stock market is a list of companies that have sold shares to the public. You can look at the stock prices for Coke and McDonald's in the New York Times, the Wall Street Journal, or online at Yahoo Finance, Google, or other sites. The stock prices tell you how much the company is worth. And how do you figure out how much the company is worth? You can look at where the stock prices are and count how many shares are outstanding. This information can be found in different filings with the SEC. When you multiply the number of shares out there by the price of a share, you get the price of the equity of the company. So, if we go back to our little lemonade stand, we have 1,500 shares of stock that are still in circulation. At first, we sold them for $1 each. An investor bought a third of them, and the business was worth $1,500 at the time. So, how much is the company worth now? So, that's one way of looking at it. Let's look at other businesses that sell lemonade. Let's say that other lemonade stem companies have sold on the private market, the public market, or both for 10 times their profits or earnings. That will make you feel like you're important. So, let's say the stock market price of another lemonade stand company is 20 times its earnings. Well, in year 5, we made $1 per share. We put 20 times that dollar on it. Based on the comparable, each share of the business is worth about $20. We have 1,500 shares out there. We take 1,500 and multiply it by 20. Our company is now worth $30,000. A business started in the year 1505. Its value is $30,000. That's a pretty good idea. Well, how do we raise $4,000? If that's the right price for our company. Well, if we sold 200 of our shares, which are worth $20 each right now, we could get the $4,000 we're talking about. What would that accomplish? If we sold 2 of our shares, what would happen? 200 shares of our company on the market. Well, our interest in the business would go down because, as of today, we own 66.23% of the company, which is 2/3. Private investors own 1/3 of what we have. Well, if we sold 200 shares of stock on the market, we would no longer own 400 shares. Our ownership stake would go down from 67% to 53%. So, the good news is that we still run the business. In most public companies, you can run the business if you own a majority of the shares. But now that public shareholders own the company, you have to make sure that their interests are properly represented. You need a board of directors, which is a group of people who look out for the interests of the shareholders and whose job it is to make sure the shareholders are treated right. You also wouldn't have as much freedom as you did when you were a private company, because you have to think about more people now. The stock would now be easy to sell because of the IPO. There will be a market where it can be bought and sold on the open market. Over time, if I wanted to sell more stock or if I wanted to bring in new investors, they could buy stock, and our stock would now be liquid. Make me feel better about this business in terms of my ability to leave at some point or raise more money by selling stock on the market. You can check the price every day on the web, in the New York Times, or in other ways. You can also find out how much your business is worth. So, what does this have to do with you? Now, the point of using our lemonade stand as an example is to give you a basic idea of what a company is, what it does, how it makes money, and what kinds of reports it gives to investors. So that investors can find out how much they are worth. And the goal of this lecture is to give you an idea of some of the things you need to think about if you want to invest some of your own money, whether you want to invest in a lemonade stand or a company on the market. Let's say you got a good job when you were 22. You put some money aside instead of buying gadgets, a fancy apartment, or a not so fancy apartment, or going out and drinking a lot. You start investing your money. Let's say you can save $10,000 by the time you're 22. Between now and the time you retire, you can get a 10% return on that money. In 43 years, what would you have? The answer is that you saved $10,000 for it. You don't save any more money because you put it to work. And every year, 10% of your money, your 43 has $600,000 in it. And the reason for that is that in the first year, your $10,000 would grow by 10% and become $11,000. So, you'll get interest not only on the money you put in, but also on the interest you got the year before. And because of this, money can grow in a way that is almost exponential. If you make more than 10%, it's clear that you can make even more money. Now that means that if you put away $10,000 when you're 22, you'll have $600,000 when you're 43. That's not too bad. What if you had to wait 32 years? The problem is that you're 33 and only have $232,000, which might not be enough for you to retire. So, if you want to be an investor, your youth is one of the most valuable things you have right now if you are between 18 and 19 years old. You want to get started early so your money has time to grow. What if you were able to make 15%? Help you understand how strong compounding is. Keep in mind that if you saved 10% of what you made for 43 years, you'd have $600,000. That's not too bad. But if you're in the top 15% and have more than 4 million, you're doing pretty well. So, it's clear that where you put your money makes a big difference in how much you have saved for retirement, and it's also clear that you saved more than $10,000. If you can put away $10,000 every year, you would have a lot of money. Now, just for fun, if you were one of the best investors in the world, like Warren Buffett, and you could make 20% a year for 43 years, you'd have $25 million. Over that time, a $10,000 investment would grow by 2,500 times. Albert Einstein said that compound interest is the most powerful force in the universe because it can make a 20% return. If you start early, get a good return, and don't lose money, you'll have a very nice retirement. Let's talk about the chance of losing money now. Now, let's say that you took a lot of risks to try to get a 20% return, and it turned out that every 12 years, you lost half your money because you hit a bad patch in the market. If you made bad decisions when you were young, $25 million at 20% would not only be worth $1.8 million in 43 years, but it would also be worth $2.8 million. So, the key to success here is not just to try to hit a home run and get the highest return, but also to avoid big losses over the long term. Okay, so according to Warren Buffett, the first rule of investing is to never lose money, and the second rule is to never forget the first rule. So, if you can keep from losing money and get a good return over time, you'll have a lot of money if you keep at it for a long time. So, how do you make money as an investor now? I'm going to assume that you're not going to go into the business of investing and that you're going to be a doctor or a lawyer. You're going to do what you love, but you're going to have some money that you're going to save over time, and I'm going to tell you what to do with it. It's not always the best advice, but it's what I would tell my sister or my grandmother to do if they were in the same situation. I think you're probably right to think about it that way. First of all, how do you not lose money? Where are good places to put your money? Even though there's a story about a lemonade stand, my first piece of advice is not to put money into lemonade stands. I wouldn't invest in new businesses where the future isn't clear because, again, you don't have to make 100% a year to be rich. You just need to invest for a long time with a good return of 10 to 15%. Your money grows by a large amount. So how do you avoid the investments with the most risk? Listed companies would be my suggestion for where to put your money. Stock market companies. Why? Because these businesses tend to have been around longer. Before they can go public, they have to pass some tests. The stocks are easy to sell. So, you can change your mind if you want to sell. If you put money into a private lemonade stand, it's hard to find someone to buy it from you unless the business does very well. This is some advice. First, you should invest in public companies. Second, you should invest in businesses that you can understand. What I mean by that is that there are lots of businesses that you deal with in your day-to-day life and in your personal life, like a store you like to shop at or a product you think is great, like your iPad. But you know that you need to know how the business makes money. The business is too hard to run. You don't know how they make a living. I wouldn't do it, even if they have a good track record. A lot of people thought Enron was a great company because it seemed to do well in the past. But not many people knew how they made their money. I'm glad I didn't do it. You also want to invest at a fair price, which is a very important factor. It might be a great business that does very well for a long time. But if you pay too much for it, you won't make much money from it. Last, you want to put your money into a business that you could, in theory, own forever. You wouldn't be sad if the stock market was too close for 10 years. What do I mean by that? Well, if you want to get a 10 to 15% return on your money over 43 years, you really want a business that you can own forever. You don't want to have to move from one business to the next all the time. What kinds of businesses can you own forever? Not many people kind of meet that standard. Coke might be a good example. Right, the good thing about Coca-Cola is that it's a business that's easy to understand. You know how Coke makes money, right? They sell a formula and syrup to bottlers and stores, and every time they sell a Coca-Cola, they make money. People will drink a lot of Coca-Cola for a very long time. The number of people on Earth is going up. People drink a little bit more Coca-Cola every year, and they sell in almost every country in the world. So, the business is pretty easy to understand. It's also a business that I don't think will be taken over by new technology or other products, right? It has been around for a long time. People have gotten used to the taste, and parents give it to their kids, so it's likely to stick around for a long time. That's a good example, in my opinion. Another good example is McDonald's. You might not like their hamburgers, but they've been in business for 50 years. You know how they make money. They open these little boxes, rent them to franchisees, charge them royalties for the name, and sell hamburgers and French fries, which people have to eat. It's food that doesn't cost too much. They are pretty good, and they keep getting bigger every year. So, I think the main message here is that you should try to find a business that isn't too hard to understand, that has a good track record over the long term, makes a good profit, and can grow over time. So, what should you look for most in a business? As I've said, we want a business that will last forever. We want a business that sells a product or service that people need and is unique enough that people are loyal to this brand or product and are willing to pay more for it. A candy business is another good example. People are willing to buy generic versions of many food products, like flour or sugar. But when it comes to candy, they don't care if it's a brand name or not. People usually don't like either the Walmart or the Kmart version. They want the Hershey bar, or the Cadbury bar, or the See's candy. They want the brand, and they're willing to pay more for it. And I think that's important. You want the product to be one of a kind. You don't want it to be a commodity that anyone can sell, because when you sell a commodity, anyone can sell it, and they can sell it for a better price. And it's not easy to make money that way. In our little example before, we talked about our lemonade stand. If you are investing for the long term, you want to invest in businesses with very little debt. Yes, there is a debt of $250. That didn't put too much stress on the company that ran the lemonade stand. But if it had been $1,000, we would have run into trouble. If he hadn't paid his debts, the business could have gone out of business and the shareholders could have lost everything. So, if you can find a company that can make good profits, it probably doesn't have much debt and makes far more money than it needs to pay the interest on its debt. That's a good place to keep your money safe for a long time. You want to go into businesses that are hard to get into. You want a business where it's hard for someone to start a new company tomorrow and put you out of business by competing with you. I mean, to go back to the Coke example, Coke has such a strong presence in the market. People have come to expect that if they ask for a Coke at a restaurant, they will get one. Someone else would have a hard time getting in. And then there's Pepsi and their other brands of soda. Maybe he's been around for a while. Coca-Cola and Pepsi have been around for a long time next to each other. So, when you're choosing a company, make sure they sell a product or service that's hard to beat by someone else and that you won't switch to tomorrow. You also want businesses that aren't too affected by things going on in the outside world. So-called external factors are things you can't change. So, you want a business that isn't too affected by what's going on in the world if the price of a certain commodity goes up, if interest rates go up and down, or if the value of a currency goes up and down. And I'll use Coca-Cola as an example. If you think about it, Coca-Cola has been around for probably 120 years. During that time, there have been multiple world wars, the development of nuclear weapons, and many other bad things that have happened. But the company makes about the same amount of money each year as it did the year before. And they're not going away. And if you look at the past, you can be sure that this is a business that will be around almost no matter what interest rates do. Whether you know that the US dollar isn't worth much or that the price of gold is going up or down. Those are the kinds of long-term businesses you want to put your money in. They are not very affected by what's going on in the world. If you think back to our lemonade stand company, there's one more thing we looked for. We had to buy more and more lemonade stands as our business grew, but each one only cost $300. But imagine if you had to build a new factory every time your business grew so you could make more and more products. Those factories cost a lot of money. Well, that business could make a lot of money from it. But to grow, you just have to keep putting money back into the business. The best businesses are the ones that don't need a lot of money to be put back into the business. They bring in a lot of money, which you can use to pay dividends to your investors or to invest in new projects with high returns. I guess the last thing I'd say is that you can invest in public companies. It's probably safest to invest in businesses that are not controlled by the government, like our lemonade stand business that we took public. The problem with a controlled company is that unless the controlling shareholder is someone you completely trust and has a great track record of taking care of so-called minority investors, or non-controlling shareholders, it can be risky to invest in that business because you're at the controlling shareholder's whim. Even if the controlling shareholder is someone you trust now, there's no guarantee that they won't sell their shares to someone else in the future. It's not going to help the owners of the business as much. So it's not enough to just have a business that makes money and does well. You also need to make sure that the people in charge of the business think of you as an owner and look out for your best interests. So, these are a few of the most important things to think about. When do you think you're ready to start investing? I'm guessing you're a student with student loans and maybe even credit card debt. Once you graduate, you'll get a job. So you shouldn't just jump in. Start investing in the stock market even though you have a lot of debt. The stock market is a good place to invest when you have a good job and money you won't need for 5 or 10 years. So, if the interest rates on your credit cards are pretty high, you should definitely pay off your credit cards first. Before you think about putting money into the stock market, you should probably pay off your student loans first. But again, my best advice would be, if your student loans are costing you 6 or 7%, well, if you pay them off as if you earn a guaranteed 6 or 7% return, you're better off getting rid of your credit card debt and even your student loan debt before you put a lot of money into the stock market. Even after you've paid off your credit card debt and maybe even your student loans, you don't have enough money in the bank so that if you lost your job tomorrow, you'd have enough money for at least 6 months and maybe even a year. Let's talk a bit about how people think about investing. So far, we've talked about some of the technical things that go into figuring out how much a business is worth. You want to get a good deal on a business you want to buy. You want to buy a business that will be around for a long time. People will have a hard time getting into that, making it hard for them to compete with you. All of those things are important, though, and a lot of investors stick to them. The problem is that when they use them, there's panic in the world and the stock market keeps going down, so the value of their IRA or investment account keeps going down, too. That people tend to do the opposite of what makes sense if they want to be good investors. You have to be able to resist the urge to do what everyone else does. Every day, the stock market goes down. Your natural inclination is to sell. Every single day, the stock market goes up. Your instincts tell you to buy. So, in bubbles, you should probably be a seller, but in busts, you should probably be a buyer, and you need that kind of self-control. You need a strong stomach to handle the ups and downs of the stock market. The key to being able to stomach the volatility. The stock market is a way to keep yourself safe. You should feel confident that you have enough money in the bank that you don't need, especially if you've been investing for a long time. That's an important point. The second, you have to realize that the stock market is a voting machine in the short term. It really shows what people want in the short term. Many things that happen in the world have an effect on stock prices. That really has nothing to do with how much your investments are worth. You just have to accept that the value of what you own can go down a lot after you buy it. That doesn't mean you really made a bad investment. Just because of the way the stock market works. How do you get comfortable? You don't buy a stock just because you like the company's name. You do your own research, learn as much as you can about the business, make sure it's a business you understand, and make sure the price you're paying is fair compared to how much the company makes. Let's say you don't like this. I don't want to invest or buy single stocks because I think it's too risky. I don't have time to look into it myself. What are your other options? You could hire someone else to invest for you. You can hire an individual money manager or a group of them. An investor in a new business has a few different options. Mutual fund companies are the most common other choice. So, tell me about the mutual fund. A mutual fund is, I guess technically, a corporation, but you buy stock in this corporation and the manager chooses a portfolio of stocks. So, what they do is get money from a lot of investors to use as capital. Let's say they get $1 billion and use that money to buy a variety of different securities. Now, the good thing about this method is that you can even do it for less than $1,000. You can invest in a diversified portfolio that is managed by a professional who gets paid to do a good job for you. So mutual funds could be a good place to put your money. There are probably 7,000, 8,000, or even 10,000 different mutual funds, which is a problem. And some of them are great, while others aren't very good. Like looking for individual stocks, you need to do research to find a good mutual fund manager. So it's not as simple as just putting money into mutual funds. So, here are a few important things to look for in a mutual fund or any kind of money manager. To choose: number 1. You want someone who has a plan for how to invest. You think that makes sense. You know who they are and what they do. If they can't tell you what they do, how they do it, and why it makes sense in 2 minutes, they're not trying to make you feel insecure by using words and phrases you don't understand. Then that's a plan. Don't put your money in number 2. This doesn't have to happen in this order. This should probably be number 1 because you want someone who is known for being honest. Again, if you're just starting out, you should probably invest in a mutual fund that is sponsored by one of the larger mutual fund complexes instead of a tiny mutual fund that is privately run by a mutual fund company you've never heard of. There are some good things about bigger institutions. For example, you can be more sure that they won't steal your money. You want an approach in which the investor puts money into something based on its value. Now, this might sound obvious, but value investing has been around for a very long time. People now also invest in other ways, like technical investing, where they bet on stocks based on how their prices move. But I strongly advise against taking those kinds of steps. So he wants people to make investments where they buy companies based on the belief that the business will do well and that the price paid is a big discount compared to what the business is worth. you want to put your money with someone who has been around for a long time. Long history of success. And I'd say that 5 years is the very least. And ideally, you want someone who has been investing in the markets for 10, 15, or 20 years, because there's a lot you can learn from being a long-term investor. You want someone who has a consistent strategy and hasn't changed what they do much from year to year. They should have a stated strategy that they've stuck to through good times and bad, which has helped them earn a good return over the course of their investing career. I always say in some ways. Most importantly, you want someone who is investing a large amount of their own money along with yours. You want to be with someone whose goals are the same as yours. If they have their own mutual fund, you want them to have a lot of money in it. If it's a hedge fund, which is a private fund for investors with more connections, you want a manager who is also investing. We started with a small lemonade stand business. The point of this was to teach you some of the basics about how to think about a business, like where the profits come from, what revenues are, what expenses are, what a balance sheet is, what an income statement is, how to figure out how much a business is worth, how to tell the difference between a good business and a bad business, how debt is usually lower risk but has a lower return, and how equities work. We just use that as a starting point to learn a few words about investing. We talked about buying and selling stocks. We talked about how to choose investments and how to deal with some of the psychological issues that come up when you invest. We went to a lot of different places in a short amount of time. Now, I gave the talk the title in less than an hour, You Can Learn Everything You Need to Know About Money and Investing. Well, it's not actually all you need to know. It's just a brief introduction, so I hope I didn't trick you into watching this. But there is a lot more to learn, and there are some great books you can read to learn more. So I think what's interesting about investing is that if you're going to be successful in your career, you're going to make some money, and it's interesting to see how you invest that money. You can make a big difference in the quality of your life and the lives of your children, as well as in the kind of house you can buy and the kind of retirement you can have. And we talked about the difference between a 10% return and a 15% to 20% return over a very long period of time. How does that affect how much money you make over the course of the time? So, whether you like it or not, investing is going to be important to you, and learning more about it will have a big effect on your quality of life. Money is something you need to reach some of your goals. I became interested in investing when I was probably 22 or 23 years old. And I read a book called The Intelligent Investor, which was written by Ben Graham. Ben Graham is a well-known value investor, and it's kind of like reading Jean-Paul Sartre's Essays and Existentialism. You read it and either have a big realization that changes the way you live, or you don't care about it at all. This was the same thing. But investing was interesting to me. And I liked that investing is something that even someone as young as 22 or 23 can do. What's kept me interested is that it's one of the few jobs where you can learn something new every day. You're always learning about new businesses, situations, management teams, and problems. So it's always a challenge. The world and the stock market are both places with a lot of change. So, the challenges keep bringing up the same ideas, which can help you figure out how to invest your portfolio. They can also help you make important decisions, like whether to buy a house or hire more people for your job or in your line of work. You know, these kinds of calculations and ways of thinking are useful and can help you in life. And I think you should learn more. Thank you for listening, and I hope everything goes well for you.